Alright, first video on the channel. Welcome. In today's video we're going to be explaining basically this 1 minute strategy is literally the best strategy and the only strategy you need, and not ICT. Now, as someone who has partaked in ICT trading myself, I can say it works, but it does not work as half as better as this. The win rates may be higher, but the RR, the risk to reward trades, are inevitably not higher, because it simply falls for this to ever beat this trading model right here. So a couple days earlier, I don't even know how long ago, but I took a trade right on Bitcoin, right? So as you can see on the daily time frame, we're obviously in a fat ass uptrend, just up, down, up, down, up, down. I am a firm believer that market structure is BS. It is literally useless if it is not following liquidity code. So we go on the weekly and we see that price has basically shifted down for a while to retrace back into this demand zone. It bounces off of it and then creates higher highs after sweeping liquidity right here, and right here. So right when it hits a premium area or discount, I had two basically biases: to go to this other area right here, this lower area, or to go to the extreme. And this is our swing. This is our swing. So if it broke this low, I'm like, okay, this might not be bullish. So then we go down to the 4 hour. Now look for my market structure with liquidity for my entry. So after price bounced off of that demand zone, it went to this other demand zone on the lower time frame of the 4 hour. Now this like little bit of a consolidation, this little bit of a downtrend kind of price action was literally over a couple days, like not a couple days, a couple weeks or so. I don't know how long, but it was a long ass time. Anyways, yeah, it was basically just a long ass time, and I was like, dang, is this market bullish? Is it bearish? Where is it going? But then after I simplified it, oh, it's just hitting to a demand zone. So here are some of my trades. This looks so confusing when you first look at it, but I swear it's not confusing. Right here, we see this lose. I'm going to show you my losses because I'm not ashamed of my losses. Every trader loses. So we see, I thought this was going to go bullish because, okay, it's hitting a demand zone, right? It's probably going to come up here to this higher demand zone, and then it's just going to bounce and go up. So I placed my entry. I was going to go on a quick trade. I went to the 1 minute time frame to do that trade and to hit a 1 to 7, and that would have been a phenomenal trade. But price just randomly decided, nope, I'm just gonna go up and then sweep everybody out and go down for a retrace. Now initially I thought it was gonna be a retrace to this area. I was like, oh, it's probably gonna go down here, but you know what, I'm gonna buy high. And I was following the logic of this demand zone, right? But nope, it went to this demand zone, didn't break the low, and then went back up. So then I took another trade right here. Oh, actually I took two trades. Okay, so the first trade was this one right over here. You see that price is about to basically go back down to this demand zone that I marked out earlier. And mind you, price needs liquidity to fuel their moves. If it is not sweeping liquidity, the breakout trading strategy does work. If only if price sweeps liquidity. So if price sweeps liquidity, it comes back, you could trade this. You could trade the retrace, and if you have that stupid, okay, it's not stupid, but it's not highly probable for a long term 1-to-1 risk to reward ratio, you could win this. You could definitely win this. In fact, you could even win a 1 to 2, a 1 to 3, a 1 to 5, the whole shenanigan. What the hell am I saying? Anyways, yes, it does work. However, it needs liquidity to fuel the move. So as we see right here, price swings way up in this demand zone. It's the impulse. It comes down, it comes back up, comes back down, comes back up, and then it breaks structure. Now, market structure only matters if it is paired with liquidity. And the liquidity is that it is trying to sweep as much liquidity as possible, go up, and then eventually come down. So this was a riskier trade, I would say, because from this area right here, price literally could have just went down. It could literally just swept this liquidity that are resting at this swing, well, not swing, this high, and could have just like, no, I'm just gonna go down here, thank you very much. And that would have made a lot of sense. But I just bet on myself because I'm trading on the 1 minute time frame. And mind you, if I'm trading on a 1 minute time frame, what does it matter if price is going to do 5 minutes later, 15 minutes later, 30 seconds later? Well, 30 seconds doesn't matter in this case, but you get what I'm saying. It doesn't matter because it's too early. So you mark out this demand zone right here. This is the demand zone right here. From the 1 minute time frame, you mark this thing out. And then guess what? Right when price comes back down, it tries to go up for a while, but then it hits the optimal zone. It sweeps liquidity, and then it starts printing these swings that are just uptrend. And I hit a 1 to 5.34, which is phenomenal. Then, as we see later on, price shifts structure to bearish to downtrend. This is just perfect because I caught this small move on the 1 minute time frame. I risked as normally as usual, and then guess what? You could have caught this short to the downside if you marked out this demand zone, not demand, supply zone. Price comes down, retraces to the demand zone, and then it hits another one, and then it completely fills this unmitigated, as you ICT traders call it, order block, but I just call it demand zone because supply and demand has been around for way longer. But whatever you want to call it, let's be fancy. Anyways, it hits this and it goes down immediately. And from here, if you took this trade from here, you would have gotten, if you targeted the demand zone in which we were trying to go to, dude, a literal 1 to 10 risk to reward ratio. And mind you, this strategy is profitable and it has a high win rate. Right now, my win rate average is about 73%, but as win rate works, it goes up and down depending on the month or the week or just the market conditions. So sometimes it goes down to 60%, sometimes it's as high as 90%, but that was like, it's unsustainable in my opinion, in my wholehearted opinion, with these high RR trades. So what fueled this move? This sweep of liquidity. Everything is biased off of liquidity, and after it swept it, it went to the direction in which we were targeting for a liquidity stop. So guess what? After you would have came and made this 1 to 10 trade, you would have hidden the demand zone, and you would have literally printed money. After, if you would have bought right here, you would have printed money, and it would have went all the way and swept these highs. And literally, this was so stupid. This day I took like 3 different losses. No, actually it was 2 losses and 1 break even, but let's just call it 3 losses. I took 3 losses because I just didn't know where the direction of the market was going. At the time, I didn't even know that it was bullish. I thought it was bearish, but I was still getting these buy orders in, and I was just being a dumbass, if I'm being completely honest. So here's how to avoid that. I, in those 3 instances, was a liquidity. Oh, it's gonna go higher, it goes low, it sweeps me out. Oh, it's gonna go higher, it goes low and sweeps me out. Oh, you're gonna go higher, it goes low and sweeps me out. It swept me out like 9 times. Okay, not 9. I'm exaggerating, but you get what I'm saying. It swept me out. And then when it hits this demand zone right here, it goes in a beautiful uptrend to the upside, making all of my money back and more. Why? Because all of this was the liquidity, and it wanted to reach to this demand zone to then push higher and print new highs. In fact, I could have literally targeted all the way up here, and estimatedly I would have, actually no, factually, I could have made a 1 to 18 trade just by A, looking at the high time frame bias, B, looking for a liquidity sweep, and C, a demand zone or order block as you call it. Now, ICT strategies do work, mind you. I am not an ICT hater. In fact, anything that is pairing the laws of supply and demand, the laws of liquidity, and just in general market structure, paired with liquidity, of course, will always work. In a certain way, in a different way, in any way. Alright, it works. However, this is so much better in my opinion. So much better. So the same thing happens time and time again. As a institutional or a BFI, or like banks, financial industries, anything, they want to push the market in an area where there is a lot of liquidity. So let me give you an example. Say this is an area of liquidity right here, and this is where the banks are. Instead of just going in the direction, going up or going down, they want to go in a bearish or bullish scenario. They want to go in the opposite direction, going down or going up, to sweep that liquidity and then go into the opposite direction. Not opposite direction, the normal direction. So they're obviously going to sweep out this liquidity and then go in the direction they want because they need opposing orders to do so. For every buyer there is a seller, and it is equivalent. And when there is more buyers and sellers, it's bullish, and when there is more sellers and buyers, there is bearish. So it needs to sweep liquidity before fueling the move to the downside. Any move needs to sweep liquidity. So let me give you another example. It sweeps liquidity, all this liquidity that's resting right here. It comes to this demand zone, and then it goes down, and you would have literally printed. You would have, let's say you would have been a little unsure, you would have put it all the way up here, and you would have targeted a 1 to 2 would have worked. 1 to 4 would have worked. 1 to 5, 1 to 6, 1 to 7. And guess what? A literal 1 to 9 would have worked on this strategy, and it works every single time because this is the laws of how the market moves. So today on Bitcoin we had a crazy up move, then a down move to this demand. In any instance, you probably could have, after hitting this demand zone over there, could have looked for your entry because this is the liquidity and this is where it is reaching and where it's going. Because price just wants to print higher highs because it's bullish, because I'm impairing it with the high time frame bias. Off the bat, my bias is bullish for the day, but however, you can still take shorts in a bullish market because we're on the 1 minute time frame. Alright, right here, we have a demand zone. Bounced off the zone, came back, tricked all of these breakout traders, went right back down, then came back up. And then came right back down to come right back up. Makes a new demand, and goes right up. So, right here, it sweeps all this trendline liquidity, sweeps this low, another low, all the early buyers who bought right here, swept them all out to come to this better zone, the unmitigated zone, the premium, whatever you want to call it, zone. You could have went on the 1 minute time frame. You could have set your stop to the middle points of the demand. Targeted this right here and made a 1 to 10x profit in a day. Guess what? You can even take these short ass trades right here. Look at this. It sweeps the high, but it doesn't sweep this other one. It sweeps all the liquidity needed to fuel the move down. If you would have placed this right here, the middle point of the demand, you would have printed a 1 max, you would have printed a 1 to 7.85. But let's be for real, on a 1 minute psychology, it does not take that much. It's literally zoom or boom, you lose. What we're looking for isn't to catch an uptrend, because uptrends, in my opinion, no, well, in reality, I just showed you, are BS. Uptrends do not look like this, guys. This is a simplification. Uptrends are like this, guys. This is a realistic uptrend. This is a realistic uptrend. And guess what? These uptrends always sweep liquidity, because liquidity is needed for the market. Now, what is liquidity, you may ask, as some people, beginner trades. Liquidity is just money. It's people who are buying or selling the market at the same time, and price needs this liquidity to fuel the move to go to the upside, because for every buyer there is a seller, and for every seller there is a buyer. So if you are a millionaire and you put 1 million bullish in the market, you need a 1 million sell order. So why would you not take everybody out, get your $1 million in the equilibrium, and then push the price up? Why would you settle for a worse price if you have the power to do better? You have to always think like that. Think, what would a greedy person do in this situation? Always think about greed. And guess what? For this uptrend scenario, it is always hitting some type of demand zone to go up. At every moment, there is probably going to be a demand zone. And then, this is just how liquidity works. Liquidity sweeps, or what some people may call it, liquidity inducements. For a downtrend scenario, it's the exact same. Goes down, goes up, goes down, goes up, goes down, up, down, up, down. It is always sweeping these highs